Welcome back to the Dan Habib Show. I'm your host here, Dan Habib. Thank you guys for joining me. Want to just remind you, if you're in the mortgage space and you want to get intelligence like this every single day, make sure to check us out at mbshighway.com. And if you're interested in investing in crypto, learning more, making sure that you have the best advantage when you are going to invest, whether that's insights, technical analysis, coin breakdowns, you name it, take a look at us at cryptocharge.com. And special for this show, if you sign up today and you use the code Habib, it will give you a 40% discount. So, team, let's jump right into it. The Fed decision is now behind us. And boy, I am excited to get this week behind us because it has been a volatile one. The Fed came out and, as expected, hiked the Fed funds rate by 75 basis points. They also released their projections. Now, their projections, well, they're for more hikes. They raised their expectations for the Fed funds rates by 100 basis points. So what that means is this. Throughout the rest of the year, there is 2 more meetings. They're expecting 125 basis points of hikes. How do I think that's going to look? 75 basis points in November, most likely, and then another 50 basis points in December. Now, let's have a little reminder here. What is the Fed doing when they are hiking rates? They are literally trying to slow down and destroy the demand side of the economy to combat this global and, of course, U.S. problem of way too hot inflation. You guys are all feeling it. Prices everywhere are much, much more expensive. And it is a problem that the Fed is dedicated to fight no matter what happens to the economy. But is the Fed going to go too far? Well, you have to remember this. When the Fed hikes the Fed funds rate, this is a short-term, overnight rate that banks lend to one another, but it makes certain things more expensive. Car loans, credit cards, personal loans, small business loans, and it has a slow down effect on the economy, but it doesn't happen overnight. Now, yes, the stock market, the bond market, the crypto markets, they can all try to anticipate what that means and price that in, but the actual impact on the economy is not felt for maybe 3 to 6 months. So the question is, and the Fed always does this, is the Fed going too far? Is the Fed tightening too much without realizing the effects yet? And my good friend Peter Boockvar, he's at Bleakley Advisors, one of the smartest guys out there. He's on CNBC regularly. I want to just share with you his analogy because I thought it was worth mentioning. Now, I don't know this from personal experience, and neither does Peter, but it's almost like if you were taking a gummy or an edible, right? Now, those people that maybe are inexperienced don't realize that it takes an hour for that approximately to impact your system. So there's people out there new to this. After 30 minutes, they don't feel anything. They take another one. After 45 minutes, they don't feel anything. They take another one. Well, then all of a sudden, the hour mark hits and they get hit with a ton of bricks and they're completely discombobulated. Now, this is an analogy to what the Fed may be doing. The Fed is hiking, and in many people's eyes, being too constrictive on the economy, and we haven't realized the impacts of it. And what is that going to do? Is that going to destroy the economy? Is that going to send us into a recession? Well, I certainly think so, and there's a lot of indicators out there that are showing this. Number 1, 2 consecutive quarters of negative GDP, but Q3 expectations, the Atlanta Fed does projections on this. Just a month ago, their expectation for Q3 GDP was 2.6%. 3 weeks ago, they cut it in half to 1.3%. Last week, 0.5%, and just 2 days ago, they cut this to 0.3%. I believe this is also going to be negative. I believe this is going to be 3 consecutive quarters of negative GDP. And everybody out there, you see Goldman Sachs, you see Fannie Mae, everybody out there now starting to hop on the bandwagon that we've been talking about for a while, that we're going to have a hard landing. We're going to head for a recession. But it seems like everybody out there thinks so, except for the Federal Reserve. They're not going to come out and admit it. But take a look at the yield curve. The yield curve is normally up and to the right. That means if you put your money away for 10 years versus 2 years, a longer period of time, you'd expect to get a higher rate of return. That's how a normal market works. Well, after the Fed hiked and short-term rates really shot up, the 2-year jumped above 4% for the first time in a long time. The yield curve is now inverted by about 56 basis points. So that means if you put your money away for 2 years versus 10 years, you're getting 56 basis points more from putting it away for 2 years. Now, that sounds backwards, upside down, or inverted. Why is this important? It shows you that the expectations in the market in the short term are much worse than that in the long term. There's a lot more risk, fear, and ultimately weakness in the economy. Now, if if you look historically, every time you see an inversion, especially one of this depth, this is the deepest inversion we've seen since 1982. Every time you see that, you get a recession. Not to mention, there's other indicators out there. Some of them that are lagging are the employment picture. Many people out there saying, well, you can't get a recession because the unemployment rate's only 3.7%. That's when you precisely get a recession. It's when the unemployment rate hits its low, begins to turn higher, the economy slows, people reduce headcount. Those individuals that are newly unemployed, they have to reduce their spending. Those companies relying on that, they have to cut headcount, and you get it to shoot up rather quickly. And guess what? In the Fed's expectations, they expect the unemployment rate next year to be 4.4%. They also cut their growth estimates. This is the Fed's way of saying, hey, guess what? We probably are headed for a recession, but they are not going to admit it. Now, what does this mean for us in the markets? What does this mean for us for interest rates as investors? Well, right now, interest rates have recently just moved up. And I've been preaching to you that when the Fed hikes, it doesn't necessarily mean that mortgage rates have to go up. In fact, if it's perceived that they're curbing inflation, you can actually see mortgage rates come down. We have seen this happen many times in the past. Paul Volcker in the 70s, he hiked the Fed funds rate 9 percentage points, and mortgage rates came down 6%. In the 90s, Alan Greenspan hiked 1.75%, mortgage rates came down 3%. But it doesn't happen right away. So far, we have not seen it be perceived that the Fed is curbing inflation. In fact, based on the Fed's projections and their statement, it looks like to me the market is saying, oh no, the Fed really doesn't have control over inflation. Yes, they're hiking. Yes, that will impact it down the road. However, it seems like the Fed has lost control. The markets do not have a lot of confidence that the Fed's going to get this thing back under its reins. And that's why we saw interest rates move higher. And of course, when the Fed tightens, that is going to cut down on multiple expansion. It's going to have multiple contraction, actually. Stock market does not like this. Stock market doesn't like inflation. And this is why we saw really all of the markets sell off in a bad way this past week. What do I expect going forward? I expect to see mortgage rates and inflation come down probably around November. When you look at the comparisons, they get much tougher. The Fed rate hikes will start to impact more. The economy will continue to slow. I believe we will be in recession-like conditions towards the end of the year, at the latest beginning first quarter of next year, if we're not already in one. Remember, this is a back-looking indicator. We won't know we were in a recession until at least 6 months later. But I do believe that means we will see mortgage rates begin to come down. End of the year, beginning of next year, you'll start to see mortgage rates come down. I believe you will see rates with a 4 handle in front of it at some time next year, meaning mortgage rates will come down beneath 5%. But the bad news here is the equity markets. We are headed for a recession if we're not already in one. I think it's going to get uglier. I would not be surprised with all this going on and the Fed continuing to hike and slow down the economy that we are going to see the S&P 500 come down in the range of 3,000 to 3,200, possibly getting as low as 2,700. So seeing at least a 20% decline in the stock market from here. How about the cryptocurrency markets? Well, they're going to follow suit. We know because of the participants involved, it is at least an 84-85% correlation, that is cryptocurrencies, to the stock market. So if stocks go down, cryptocurrencies, at least at this point in time, are going to follow suit. But here's the good news. If you're smart, if you have some dry powder on the sidelines and you can be patient, I think you will have a multi-generational buying opportunity. I think you're going to be able to buy stocks at bargain basement prices. I think you're going to be able to pick up Bitcoin somewhere in the neighborhood of $12,000 to $14,000. Ethereum somewhere in the neighborhood of $500 to $600 to $700. And I believe people will look back at this opportunity as one of the best investment opportunities of a generation. So guys, until next time, stay tuned. Remember, check us out at MBS Highway as well as at Crypto Charge. We break this stuff down for you every single day, but you can count on us being back next week to break down the news. There's a lot of housing data next week. We'll get the final reading on Q2 GDP. A lot of action. We'll see you then.